Would you ever build a lifestyle business?
Lifestyle businesses are not interesting to me. We dipped in that pool of startup and we like it. We like the scale. We like the speed. How about you, Heini? Would you do it?
The thing about having investors, we can find it annoying sometimes, but they also put some structure on, put some pace on the idea of having total control yourself. It's not like founders don't control the business, but we've definitely had these moments like, God damn, I want to go in this direction. They say we should go this way, and everyone says, I want to go this way. I wish this was a lifestyle business, right? But yeah, I think I could definitely do it today. Hey everyone, this is Heini Zachariassen here, and welcome to Founders Weekly, where we tell stories you can learn from. Today we're going to talk about acquisitions, when startups are acquired by another company. What are acquisitions? How should we think about them? We will have Brian Dean on. He sold that was more like a lifestyle business to a $1 billion listed company. My co-host today is Theis Søndergaard, Vivino co-founder and a friend. Welcome, Theis.
Thank you, Heini. Always good to be here.
Yes, it's great to have you on, but let's go straight to today's subject, acquisitions. So first, let's talk briefly about the difference between a lifestyle business and a startup, as it's relevant for any conversation about acquisitions. So lifestyle businesses are built to grow slower, usually don't raise money, or at least don't raise a lot of money. Startups, on the other hand, are usually built to grow fast and raise a lot of money. Theis, we've sort of mostly built startups. What about lifestyle business? Would you ever build a lifestyle business?
It's a good question. I think if you asked me a couple of years ago, I would say definitely no. We dipped in that pool of startup and we like it. We like the scale. We like the speed. We like the opportunity.
Craziness.
And the craziness. And I still like that. I'm obviously still drawn to that. But I do also see the kind of advantage of just, being completely your own boss, not having investors to respond to, and kind of doing your own thing. Maybe have a bit more control, maybe a bit less financial opportunity, but a bit more control. So I don't know. I'm open to it by now, I think, Heini. How about you?
You're somewhat drawn to it. Maybe you got burned by, but I want to push you back before I tell you. Before I get to that, I want to push back a little bit. The thing about having investors, we can find it annoying sometimes, but they also, put some structure on, put some pace on. Are you sure you could do it without investors? Let's say even not looking at the money.
Yeah, and it's a great question, and I think it's something that we can also talk with Brian about, because he went through this acquisition without having investors, and I definitely think there were aspects there where he struggled, because there were certain things where he didn't have that structure or that discipline that he suddenly faced in an acquisition, right? So investors help, they professionalize you, but I would also say, Heine, you and I have been through the investor game for 20 years, so maybe we have been professionalized a bit. Maybe we could do this. Exactly. On our own. I think it's lifestyle businesses are not interesting to me. I think in this world with internet and AI, where there's such low costs to get going, I think everything is interesting. How about you, Heine? Would you do it?
No, I probably feel the same thing. I'm probably better at it now than I was 20 years ago. I probably have more discipline now than I had 20 years ago. All those things mean that maybe you're better positioned to just run this yourself. And I like what you said earlier, the idea of having total control yourself. It's not like founders don't control the business, but we've definitely had these moments like, God damn, I want to go in this direction. They say we should go this way, and everyone says, I want to go this way. I wish this was a lifestyle business, right? But yeah, I think I could definitely do it today. I think you think differently as you mature and so on. There's one business that I'm involved in. It doesn't always feel like a lifestyle business, but we're building a distillery in the Faroe Islands, Faroe Isles Distillery. And I do think differently about that business. I want to build something amazing. It is going to cost a lot of money to get started, but still it's something for the future. It's just there's no investors that says, hey, you need to sell this in 5 or 10 years. This is a long-term, as in really long-term build.
Yeah, definitely. Because there is also this, I wouldn't call it a middle ground, but there's a lot of businesses that are completely viable businesses that don't fit into a venture capital model, but can be sizable business and strongly growing businesses, but just doesn't require or doesn't really meet the VC requirements. And those businesses can be super interesting to build as well.
Yeah. So let's look at what the 3 outcomes are. So the thing about a startup, a funded startup, Usually you have funds in and they're going to look for some outcome at some point. And basically, there are three big outcomes, right? As a founder and somewhat as an investor, you can keep the business and then just keep the profits, right? So you make money every year on this business. Amazing. In some cases, investors would leave and they just say, look, this is not for us anymore. We'll sell a part of it, but you still keep it and just keep going. That idea is something we don't see enough of, honestly. What do you think?
For sure. And I think it's very much linked to the VC investment, right? They are looking for a one-time payment to give back to their LPs. It's not that they don't want dividends, but they'd rather, let go of the dividends and push strongly towards a higher
invest everything and then a higher exit.
Yeah.
So it's a little bit against the usual. So the second one is like the dream of every entrepreneur. Hey, do a big IPO and everyone makes a lot of money. And that can also be a hybrid. You can obviously keep a lot of the company at that point, but at least you have a value on it. And so that's, that could be a way some of our companies end up at some point, but for many, more like a dream. But what do you say?
I think definitely, like you say, it's a dream in the sense that for most companies, it doesn't happen. I also think it's a dream for a lot of founders and myself included, in the sense that I think one aspect of an IPO is that kind of public bang of
ring the bell.
Yeah, and the product you built, the brand you built lives on, right? And it's still there. It's a lot of time when we get to the third part, which is like pure acquisition. A lot of times companies get gobbled up or get kind of siphoned into something bigger, and the brand is suddenly gone and so on. So I think for a lot of founders, you look at an IPO as like the best of all worlds. The product, the company you've built gets to live on, but you get to liquidate,
legacy.
Right? You suddenly all the value you built is suddenly liquid, and you can you have much more control of your own future and destiny. So I think for most founders, I think rightfully so, an IPO is a big dream and something that we're hoping to head towards.
And yeah, like you said, it's like you reach some kind of goal at that point. You ring the bell at the stock exchange, like this is amazing, right?
Yeah.
And the third one is acquisition, right? Straight up acquisition. You build something, someone else buys it, and like you say, the first two, maybe your company lives on, the brand lives on, whatever you built is still there, some kind of legacy. Acquisition, sometimes, you could be a part of something, you will be a part of something bigger. Maybe you stand alone, maybe you don't. I mean, companies like Microsoft have done really well with their acquisitions recently. In the old days, they would eat these companies and they would just disappear. They've done better now with companies like LinkedIn and so on. But acquisitions is what a lot of people aim for, right?
Absolutely, and it is the most. If you have investors on board, I think it is of the exit scenarios. It is a very reasonable and likely scenario that you can go for because you can have strategic buyers and a lot of other things. So that is definitely for a lot of companies that do get acquired. That's the path that happens, and it can be great, right? But for a lot of founders, often it requires a bit of readjustment on kind of what you thought the future was going to be like for your product and your company.
Yeah, and I'm going to use the word easier, which I'm using sort of carefully because I'm not saying it's easier, but compared to an IPO, it's usually less complicated. Like someone comes in, gobbles it all up, and you can get a great price. Everyone's happy. IPO can be a long and tedious process. That is for sure.
Yeah, for sure. Okay. And acquisitions can also be that one out that you have when the company is actually not doing great, right? When it's no longer on a growth path and so on, and you can see if we IPO'd this, we'd get this company is kind of petered out, but it could still hold value to a strategic acquirer, and so it can still be an out.
And sometimes something that's interesting is that value, it might have a value as a standalone. Certain value, not that great, but combined with another company, it has amazing value, right? So maybe we have a special product and then someone else buys it and they can put it into their distribution. Suddenly it's worth a lot more. So that could also be it out there. But let's look into, because basically there are like three types of acquisitions when we talk acquisitions, right? And the first one we call strategic acquisition. And it is what we always talk about. Like it's the big bets. It's when Salesforce acquires Slack. It's when Microsoft acquires LinkedIn. That's a big strategic acquisition. And we love talking about those, right, Theis?
No, for sure. And like you say, it's often there where the multiples are best for
Insane.
for the acquired company, simply because there's just this additional value, right? So it's not just looking at the numbers and like, oh, this is the multiple you should get on your annual recurring revenue or whatever. But there's this strategic incentive for the buyer.
And
so
competition,
that adds
right?
value.
There could be
Yes,
competition.
often there's competition as well. So yeah.
So we talk about these, like so many examples of that. And my point here is be a little bit careful with this, because this is 90% of what we talk about, but really a small part of the actual acquisitions, and where the most money is made, or at least for most startups, it's different than this. It's not big strategic acquisitions. On that, let's go to the next one. The next one's called a tuck-in acquisition. It means a big company buys another company to make them bigger or better faster, right? They say, look, this is a shortcut to where we ever want to go, so let's buy this company. And this is much more typical, right? They buy a technology, they buy a market share or whatever, something like that. This happens all the time. And sometimes it's not even talked about, right? So Apple is famous for actually doing these. They buy some technology and suddenly a startup just slowly disappears and nobody really knows what happened. And they just do that, right? So this is a big one.
No, for sure, and it's quite typical. And like you say, maybe the multiple is not as high, but basically the acquiring company is doing this typical build or buy analysis, right? There's something they want to achieve. They want to go into a new market, or they want to add a product to their portfolio, and they look at it and say like, yeah, we can spend $20 million on building this, but it costs it takes, and that adds also time and risk to execute that. Or we can spend 30 million on buying these people and this product, and we can just tuck it into our business. So for them, it's a kind of a resource and a risk analysis, and saying like, we'd rather spend maybe a bit more, maybe even a bit less than it would take ourselves to kind of build it, and we don't have time to wait for this to happen. So we'll just find something out there and tuck it in. And that can be a product, it can be a market, it can be a customer base. It can also sometimes be a team, but I think we have that as a third
we have
one
an
with
independent,
acqui-hire, right?
but it's often a part of it too, right, Theis? So yes, but we also have a team that now builds this product in the future. Mm-hmm. I will challenge, when it comes to multipliers, they can also be crazy here, especially if you have competition, right? So there are two similar big companies that look for this particular one. Maybe they're the number one in the field. And then you can also get really, really good prices here.
Mm-hmm. Yeah, for sure.
Then there's the last one, which is less, but we do talk about it. And that's what we call an acqui-hire, which means that you've built something usually, but it didn't quite get there. But we're seeing a team that is very, very talented. This is a great team. We want to hire. So acqui-hire, acquisition, hire combined. This happens a lot too. And it's really good downside protection, meaning, okay, at least we can do something here. What do you say, Theis?
Yeah, and these days you see it a lot in areas where there's a small talent pool. So like in AI, right? A lot of AI startups. For some of them, that's even the main strategy, right? We build this product and we just bet on being in the market for long enough to create an entity that's kind of really interesting to a bigger setup, and then we get to play with the big boys. So it can even be a strategy. Often it's at the bottom of the list for a company, right? It's like, okay, if we try,
this is where you get the lowest price.
Yeah, and we tried to make this a viable business, but it didn't work out for whatever reason. Maybe we can, the band can stick together in a different setting and kind of get into a bigger setup. You also sometimes go through this period where the big companies are looking for this. Like, for example, for some years ago, you would have Yahoo having this as a huge strategy, right? They had a hard time attracting talent because they were kind of going down and nothing exciting was happening. So they did a lot of acqui-hires simply to get talent in.
And here's one thing to note here, which I think is interesting, is that it really matters where the team's at. If it's a spread out team, that maybe it's a little bit harder. If you have 12 AI engineers in Silicon Valley, that is attractive. You can get a lot of money for that. So it really matters where the team's at.
Yes, for sure. I would say, Heini, one note on all this. You keep talking up the multiples here. I think one huge thing about all these aspects and all the acquisitions is that you need to realize that when you're at this stage and you're talking to an acquirer, this acquirer is a professional setup. right? And they are smart. They know what to do. And there's not going to be a lot of money left on the table from their side. Like they are going to be pushing this. They're going to be super strict and professional around multiples and ultimately what kind of money you get, right? So realize that when you are going into this process, it's really tricky to get a good price. As you say, the key is if you can get competition, you suddenly enter into a new game. But if you are just, if you're just talking to one acquirer, you're going to be pushed on all fronts.
Yeah, and this is the only fallback. They know that you're not going to get the right price.
Yeah, for sure.
We are back. Today's guest is Brian Dean. He is the founder of Backlinko and the current CEO of Exploding Topics. Welcome, Brian.
Hey, good to be here.
Great to have you on. Okay, so we brought you on to talk about the sale of Backlinko to SEMrush, which is a New York Stock Exchange listed company. So there are many interesting things with this one. One of them is that the company was a little bit of a lifestyle business more than a traditional startup. And that's interesting. There wasn't, investors and funding as far as I know. We'll get back to that in a second, but it's really quite an interesting aspect of Backlinko. But let's start with that. What is Backlinko, or what was Backlinko?
Backlinko started as a blog, basically, where I would blog what I was learning about SEO and digital marketing. And then it sort of evolved into an education company where we had several courses on search engine marketing, content marketing, public relations, and more. And that's essentially what it evolved to at the point where it was acquired.
Yeah. And it made sense that when someone who has an SEO expert builds a blog, it gets a lot of traffic, right?
Well, yeah, in theory, but the problem is you're going up against other people that are really good at SEO. So it's actually tricky. Like I know what I'm doing, but unlike most niches, everyone knows what they're doing. So it was actually a pretty tough space.
Yeah. But I know you did incredibly well on that. So how big was the business when you came to the point when someone got in touch with you and said, we'd love to buy this company?
It was doing low seven figures at the time of sale.
Okay. Was it flat? Was it growing? Where was that in that part?
It was pretty flat. I had basically put it on sort of the back burner. I started another company that was growing really quickly. I thought had a lot more potential, and sort of just kept Backlinko on autopilot for like 2 years. And from that, revenue never really grew, but was pretty stable.
Yeah. So your feeling at the time was maybe, hey, this is a great business, but it's not going to scale to like a huge business. Yeah. So that sort of, you almost answered the next question, because this is a sort of a natural thing when it comes to acquisitions is, were you thinking about selling it? And where was your mind at? It felt like it was a little bit of a cash cow, but maybe that was an option. How did you see that?
Yeah, I would love to have sold it. I just never thought anyone would want it because like you said, Heini, it was a lifestyle business. It was a one-man show with some contractors. It was like the perfect online business, right? Like super high margins, didn't take a lot of effort. Everything was, easy and smooth, and it was no stress. There was no clients, no headaches. But that type of business usually isn't one an acquirer wants because it's so reliant on the founder. So for me, I would have loved to have sold it, but I didn't think there'd be serious interest in the business.
No, we're going to get back to that because it's really, there's another place where you are a huge part of this business, right? It's called, Backlinko, but it could also just be called Brian Dean. But so that's interesting. It's all another interesting aspect of this that you were actually able to sell it. So let's go back to when the time when suddenly something happens, an email comes in. I think that's how they approached you, right?
Yep.
What happened? You just got an email out of nowhere? I mean, you knew the company, right?
Yeah, I mean, I knew the company a little bit. I had done some like webinars for them back in the day, but didn't really know anyone on the inside and like the executive team. And I got an email from someone that was the SVP of marketing saying, hey, I just started this role. I'd love to reach out and basically kind of like, just build a relationship. And I wasn't really interested in that because most people that do that just want me to promote their thing. I get those emails all the time like, hey, I'd love to partner up with you. I'd love to, have us team up on something. And it ultimately becomes me wanting me to become a shill for whatever they're selling. And I just ignored the email. I was like, I get a bunch of these. I ignored it. So about a week later, I get a follow-up from the guy. Follow-ups are huge, by the way. And he said something along the lines of like, let me make this really straightforward because you usually write straightforward. we're interested in buying Backlinko. And I was like, okay, now you got my attention.
Got my attention. So this is we founded Vivino together, Theis and I, right? So do you think we get a lot of those emails still? Like, yeah, we'd love to partner with you. I mean, it's just madness. We get this email all the time. And like you say, the only thing they want is for us to sell their product. Like, I think some people misunderstand what partner actually means. Partner means it's like some kind of two-way conversation. Not that you're just going to be here and we're going to sell your stuff. Yes, a little annoying, I would say. But anyway, so they come back and now they're serious. Now you got their attention. Then what happens? Do you go on a call? Because you're based in Europe these days, right?
Yep.
Where are they based?
In Boston.
So what happens next? They're like, okay, let's talk at least.
Yeah, let's talk. So, I mean, that was a Friday, I think, where I got the message, arranged the call for Monday. And of course, the whole weekend, I'm like freaking out because this thing came out of the blue. And I was really wrestling with what to do with the business because I basically thought I had two options. I could sort of keep it going like I was doing, or I could just let it go. And I was really torn because I'm like, man, this thing, I don't like working on it anymore, but it's a cash cow. My SaaS company is not really making a profit yet, so I could just use this to fund that. And all of a sudden, like the answer came like manna from heaven. It was just like, boom, here's an answer to all your problems. So I was really nervous. Get on the call, and we basically chit chat about how much traffic the site gets, how much we made last year, what our margins were. And then he asked if you're interested in selling it. And of course, I'm trying to play it off like, yeah, I'd consider it. I think about it. Inside, I'm like, yes, please. I would love to sell this thing.
Buy for fuck's sake.
And he basically asked how much, and I told him, and he said, that sounds pretty reasonable, but obviously you need to check and da-da-da. And it was pretty fast, man. I would say within like half an hour, we had an offer that was more or less in principle agreed upon.
Amazing. And go ahead, Theis, do you have something?
No, yeah, good to meet you, Brian, and super excited to meet you, and congrats on Backlinko and the stuff you're doing now. So tell me a bit more about that number and that process. Like, so was this, you hadn't thought too much about this acquisition route, so you obviously also hadn't put too much thought into like that number. So how did you arrive at it, and what was your thinking around that?
I just went with 5x because that was like the going rate during the ZERP era, at least 5x. And I figured with my business being sort of weird and not really growing, that takes some off the multiple. You know what I mean? If you're growing like doubling year over year, or get these crazy growths quarter over quarter, you can command a higher multiple. I was not in this situation. It was essentially a dying business. That was a one-man show. So I thought 5x was pretty good, actually. I was hoping for 5x, and they accepted that number, more or less. And so my thinking was just arbitrary, 5x. I maybe could have asked for more because of how quickly they accepted, but who knows? Yeah,
who knows? One question as well, Brian, on that first call. So you also say this is a one-man business, and it's very much you that's put it together. At least from your perspective, my question is like, did they bring that up? Did they put something in front of you in terms of like, well, we're going to acquire, but we would also need you to still do input and like to produce these courses and so on? Was there any further ask to you on providing value going forward?
Yes, there was. So it was pretty limited though, because I had this excuse of this other startup that I was the CEO of also. So I was like, hey, I would love to, you buy the company and I come on board and just keep running it like I've been running it, but I can't. I had this other thing. So we sort of met in the middle with that. And we basically said, I'll do part-time for a year. We ended up extending that again on a different agreement. So it was essentially like stay around, help out, but it wasn't like before. I wasn't really creating new stuff. I was just more to maintaining what was there, helping optimize some things, help the transition period. But it wasn't like you come on like you were before and we're just going to run things like usual.
Yeah. And how did you feel about that? Did you have confidence that the company, the product you had built would be able to kind of grow and thrive without you? Or were you like thinking, shit, these guys are going to buy it and then it's going to kind of slowly disappear if it doesn't have the Brian magic?
I was a little concerned about that, but honestly, like it's their responsibility. Like once you sell it, you don't usually have a lot of control. It's their responsibility to do what they can with it. I was happy to help while I was still around, but It wasn't, I mean, a startup is your baby to a certain extent, but I'd worked on it for 9 years. I was sick of saying the same things over and over again. I didn't have that emotional attachment to it anymore. If it was a few years before, I would have like insisted to be 40 hours a week after the sale. At this point, I was ready to go. Like, just if there was an agreement where I just totally sold and stepped away, I would have taken that. But that wasn't really an option.
As long as you're transparent, right? You tell them, look, this is where we are. I can take 1 year of this. That's it. Then it's on them, right?
Yep.
Okay, Brian. So one thing, the price is out there. You know, it was sold for $5 million. That's pretty public information at this point. So I was thinking about playing a little game with you here. Are you excited now? I think you are. So I've had this advice a couple of times when it comes to selling a company and what you were thinking over that particular weekend. And someone said to me, Heini, you need to think about 3 numbers. One of them is that's something you would never sell to. I won't sell at this price. No bloody way. Number 2 is, yeah, I'll have to think about it. And number 3 is, yes, I would sell right now. What do you think those 3 numbers were? And did you think that over the weekend?
The no was anything below 3.
Yeah.
4 would have been, yeah, I'll think about it. And 5, which is the number I put out there, was like a hell yes.
Okay. That's pretty simple, right?
And above.
Yeah.
Now that I look back on it, I should have had like more of a chess approach to the whole thing. But I was like, you know what? I have another company. I want to sell this thing. They said yes on my sort of higher number without negotiating down. Sounds like a great thing. Sounds like a great outcome. So for me, I didn't really want to be cute and start going back and trying to renegotiate or anything like that. Looking back, maybe I should have started with my only kind of lesson that I would maybe apply again would start with the higher number, because you really don't have anything to lose. What I've learned through this process is that if you're selling to a private equity or a publicly traded company, they don't play games and they don't really care if you are acting reluctant to sell like I was trying to play, like, oh, I don't know. They don't care about that. They're numbers people and they know the numbers. And if you make an offer that's too high, they'll just bring you down to their maximum number. So there's really no harm in maybe going above what you're comfortable with. But I was afraid like they'll say no and then they'll just say no in general. Which looking back was silly, but at the time you have all this emotion. And like you said, Theis, I didn't have a ton of time to think about this. It was basically a weekend. And then I was like, okay, ready to start negotiating.
Yeah. I mean, let's just like establish you got a great price first. You're fine. But the only risk you really had was like, let's say you had said 7, then you had something to work with. The risk you had, which I've seen before too, unfortunately, if you said 15, they might have said, look, he's so far away from us. Yeah. We're just going to back up. That happens sometimes, but that's what you need to be careful of, I think.
Yeah. If you say something like that and then they say no, then it's really hard to come back. You've lost a lot of credibility to say, actually, how about 7? You're offering half of what you just asked for. Like you basically just torpedoed your credibility and trying to be too cute. So I agree with you, Heini. Like you don't want to just put out a wacky number and just try to play the lottery. But if you have that range and you have that top range, maybe go a little bit above your comfort level with the first ask. And then best case scenario, they say yes. Worst case scenario, they say no, and they take you down to something reasonable.
Okay, we are back. I want to dig a little bit into the process. Like we talked about, hey, an email on a Friday, a lot of thinking through a weekend, and then a conversation on Monday where you sort of mentally look, they like this. I've told them everything truthfully, and they want to give me an offer of this number that I really like. But then on a Tuesday, you don't sign the company off, right? It takes a little bit longer. Tell us a little bit about that.
Yeah, a little bit. I mean, well, I went through this completely blind. I actually thought it would take about 2 weeks to close. Super naive. Especially because things seem to, like, I sort of extrapolated. If it's going this fast in the beginning, then the whole thing would only take a week. Totally not the case at all. And I mean, we signed a letter of intent very quickly after that too, which has also got me into the thinking like, okay, we're close. Not realizing that the space between letter of intent and closing is a massive gap. You have due diligence, you have the agreement itself, which are the 2 most important parts of the whole deal. Like without that stuff, it never happens. So actually I flew out to Boston after I signed the letter of intent to meet with the team. And I thought that we're going to close the deal there and sign the deal. So I remember meeting them and being paranoid they're going to slide the agreement like across the table, like in a movie. And I was going to have to read it, and I didn't have a lawyer yet. And I was like, oh my God, they're going to like have all their team of lawyers, and I'm going to be like outgunned in this thing. And turns out we weren't even close to that. It took about over 3 months between that phone call and actually having the deal close.
Wow. I will say one thing here. That's not a long time. That's a really good process. Go ahead, Theis.
Yeah, for sure. But to your point, Brian, you don't know that going in, right? And a lot of times the tables are not even, right? The ones acquiring will have done it before and have a lot, or at least have a lot more access to lawyers and so on. And
Totally.
a lot of time, founders that sell are in it's the first time, and they go through this kind of blind. So it's a really tough process. During that, my question is, during that, I don't know what was 3-4 months process until actually you ended up signing, was there from their part, was there any kind of slicing of the sausage in that part where they were kind of using the time they had to sweeten the deal for them and not for you, or how was that process?
Fortunately not. They were totally above board. I mean, the letter of intent that we signed was more or less what was signed in the end. Like, I don't think it changed at all. Of course, when you have an agreement like this, you're going to have things that you disagree about, different clauses and things. And that's why I had my attorney look through it too. But these weren't like, oh, now that we're doing due diligence, we see some problems and we have to readjust the offer. Like, they never did that. So that was good. But yeah, there was a little bit of back and forth, but I was super motivated to sell. So I wasn't too picky on the terms of the contract. Most of the delay was just legal stuff. It was like agreement and then due diligence. Oh, we need this. Oh, actually, we need this. We need this. We need this. And that sort of kept going for a couple months until it was like Christmas Eve when we ended up signing, because it was just like that deadline spurs action. And that was the deadline that sort of got us to the finish line.
Were you ready to leave the table? Let's say, 2 months into this whole due diligence process, and you feel like you've done a lot of work. You feel like you have an agreement. Would you potentially have left the table at that point if they had done something, let's say, unreasonable in your eyes? Or like, would you have been ready to be pushed even on the price? Where were you mentally?
I would have been flexible on the price, to be honest, because I was so ready to sell. But one thing to keep in mind is that even though this process was not even that prolonged, like Heini said, it was a normal amount of time. Even though I didn't know that, it wasn't adversarial, and it felt like we're already moving towards like working together. It felt like a real partnership. Like, we're already talking about what we're going to do after the sale, what my role is going to be, how I can help them, how we can scale, because that was one thing that the business lacked, was this ability to scale, because it was me and contractors. Well, they have all these resources and expertise that they can bring in. So the whole time we're selling, it wasn't like us. It didn't feel anyway like us against them. It felt more like a partnership, and we're all moving towards this together. And even though things were a little slow, they never really just stopped for any period of time.
No, it didn't feel like they just weren't fucking with you. They were just doing their work, right?
Yep.
How was that emotionally for you? I mean, this is tough, right? You're mentally going somewhere else, and deal isn't closed till it's closed, right? How did all that feel?
Yeah, I mean, it was stressful mostly because I was worried about the deal falling through. And even though all these things are great, like you feel like you're working together, I flew there and met everybody. It went well. We had a letter of intent. Like, nothing's official until it's official. They could literally send an email one day, say, actually, the board had a problem with the deal, so we have to back out. Or the stock market goes down. Oh, actually, we have to make some changes here. We have to prioritize something. Or the contact at the company that I had got fired eventually, like a year after the deal. If he got fired during the deal, that was like my guy pushing the thing forward. If he left or something, then it could have fallen through. So that's always the concern, is just like, oh, I've went through all this. We're so close, but you're so not either. You're one email away from the whole thing evaporating. So that was more the nervousness, was I felt like was like spinning plates, and I had to keep them all. And if I like kept my eye off the ball, then they would all fall down. Looking back, the stress didn't help in any way whatsoever. So it's sort of pointless. But at the time, you do feel this like stress, like, man, I want this deal to go through. And if it doesn't, I'm going to be devastated.
It's rough, right? It's rough for someone who's in it. It's a long period. Like I've tried it, Theis has tried it, especially through funding rounds. It can be incredibly painful because you have these. It could be like a morning email, and then just holy shit, everything is upside down. One thing I want to comment, like Brian, you're just so right about pushing it forward because time is really your enemy. Like anything can happen. Maybe there's a CEO you never met. In this case, you had, but she gets fired and then the deal's off. Like anything can happen. That's totally out of your hands. One like really small trick I learned while doing this, a lot of due diligence and so on, is that when they start asking questions, when the first question comes in, put a number on it. Go back. This is question number 1. And then just keep cooking numbers on it. And the thing does a couple of things. First, you can say, no, I put it so I can have a reference. But when they get to question number 89, they're going to get a little bit more careful. So just keep putting those numbers on there. I think it works really well. It messes a little
That's really
bit
smart.
around.
I wish I did that because it got to like 100 something probably. And if they were numbered along the way, it would have seemed unreasonable. But it was just, that's really good advice.
Cool. Any other things you want to talk about the process here, Theis, or the went through here?
No, I think it's easy for all of us to say that you shouldn't worry, and if worrying helped, I would have had a lot less problems, and so on, right? But the truth is just that when you're in this situation, it is just stressful, and you do worry about it, and rightfully so. This is meaningful. It's a meaningful outcome for you, and it's not a level playing field. It's not as important to them, right? They do want the deal done, but at the end of the day, if this VP wakes up on Monday and the deal is gone, okay, his life goes on, their company goes on. And so for you, it's just, you are just way more invested in this. And so of course you worry, and it's hard not to. But I wanted to ask you through all this, what's your kind of biggest takeaway or learning? What would your like number one advice be to someone in your position that maybe has, got that email and can see that, okay, I'm actually going to go through an acquisition process?
The number one thing would be to find a great lawyer to help you through that has experience with acquisitions. That was huge for me. Like that was one of the things that helped guide me. So before the lawyer, that's when I thought it was going to close when I was there and all this nonsense. Once I had him on board, it added a lot of clarity, and I knew whether to freak out about something, not freak out about something, whether something's concerning. And he could sort of be the bad guy in sort of when we're really pushing to close a deal. He could be that annoying person who's like, okay, so we sent something, should be ready to close now. Or maybe not as forward as that, but something along those lines. Hopefully we can close next week. Hopefully we can close next week. And you say it enough and it kind of like becomes true. And and also the practical aspect of the agreement, making sure there's nothing in there that you don't want. Like we had a non-compete obviously in there, which makes sense, but it was maybe a little bit broad. Maybe you should, focus that a bit more. Things like that, where you feel like you have someone in your corner who's been through acquisitions before, and he just had gone through a pretty big one. So he knew how the whole thing worked, and he was sort of an oracle that it had access to throughout the process. So I wouldn't say like the first thing you should do is get a lawyer, because you won't necessarily need him until at least till the letter of intent comes in, but you will need him eventually. And he or she can really be helpful as like a shepherd through that process.
Yeah, sure. How did you pay for that? Was it on a retainer, or was it no pay, no gain, or what was the deal with the lawyer? It was hourly, so that's tough. Yeah.
That's how I knew things were dragging. Oh, sorry, Heini.
Yeah, go ahead.
Because he was telling me to actually it's time to close the deal. He was the one trying to end the process, and he's getting paid by the hour. So I was like, okay, that's a sign that things are probably ready to be closed, and there's nothing really left to do.
Yeah, and that's the problem as well here, right? That there's a third party, which is the lawyer part, right? Which again potentially is misaligned with everybody's interests, right? Because I mean, if they are paid by making a deal, then they'll push for it. If they're paid by the hour, they will definitely put in, question number 120.
The tricky part is no matter how you structure your agreement with your lawyer, the other side is probably going to have hourly attorneys. So it almost doesn't matter in that sense. Like you can say you hire someone and you close. Yes, they're going to be as efficient as possible, which is good. But I don't know if it'll result in a deal closing faster, because the other side is usually going to have hourly on retainer, at least, if not on staff lawyers, whether it's PE or another company.
Yeah, and they just have a different, again, like a different profile towards this acquisition, right? They want to make sure that everything is crossed, and all the I's are dotted, and so on, because they don't want any liability to go in, especially if it's a listed company.
Yeah.
So they'll just go through all this, right, and push you through it.
Yep, they did.
Yeah, we talked about earlier, like the playing field is so incredibly uneven. You come into that boardroom like alone, and they have a full machine ready, and that lawyer can just change that. It really, not that it's saying it's an even level playing field of that, but it really moves you up. I think it's crucial. The other thing I want to say to that is also, we might have a tendency to use whatever lawyer, sort of, shall I say, house lawyer, whatever you use for divorce or whatever. But I would also say, find someone who's done it before. Lawyer is just not enough here, and you did that clearly, right?
Yep. Yeah, I mean, any lawyer can look at the agreement and probably they'll understand it better than you, because it's all the legalese in there. But when it comes to the nuts and bolts of like actually going through the acquisition, identifying those things, which things to like really put your foot down on, which things to let go, that only comes from experience with M&A.
Totally. They can drive the process. They can be a key person to have on board, for sure.
Yeah, like you say, Brian, it's also about education of you, right? As to understand the process of like, hey, listen, at some point they're going to come with reps and warranties and ask you to sign off all kinds of responsibilities and say that yes, it's all going to be your fault if it's like, just to understand that, okay, this is down the line. These are the things that they're going to come with.
And it's standard, right?
Yeah, and that is standard, but that you should have the lawyer in your corner. But just, kind of to educate yourself on the process. I think that's also where a really skilled lawyer can help you out, or should help you out.
So I'm going to ask one question here, which a lot of founders experience a little bit of emptiness after an acquisition. But I think you were really quite busy right away because you had nothing. So you didn't get that, right?
Unfortunately, no. I kind of would have loved some like emptiness and longing and existential crisis. I didn't have any of that. It was like I was running on a treadmill, and then I just jumped over to the other treadmill next to me and started running again.
Because you couldn't help it.
Like the day I sold, I mean, I'm still answering emails from exploring topics, looking at features and whatever. So it never really felt that. It was obviously, but the good thing was it was a lot less time, because when you're running a business and selling, you have to do all the selling stuff, and you need to run your business too, because you're legally obliged to, because of the letter of intent. They usually specify that you need to run the business as usual.
Yeah. Maintain it.
Plus you should anyway, because you don't know if the deal is going to happen, and you have all this other stuff. So I had basically the acquisition, exploring topics, and backlink at the same time. So taking two of those off the table was huge. So even though it wasn't like this total downtime, what am I going to do with my life? Should I start another business? Should I start woodworking? Never had a chance to do that stuff, but at least it took a lot of stress off. I mean, I literally went from like super carefree during this due diligence process, super stressed, teeth grinding at night and all that stuff. Once the deal closed, it was like secured. So
amazing. It
really was exactly what the doctor ordered in terms of that. So to answer your question, I never had that like total gap, that emptiness, but it also took a lot off the plate and made my life much easier.
Cool. So when you got that email back then, you were a little bit surprised. Like, this is not a typical company to be acquired. But now it's been a little bit of time. Why do you think because of you being such a crucial part of it and smaller business, so on. So why do you think they acquired you?
Well, I mean, I did get it. Like, once they sort of explained it, I did understand why they wanted it. It was essentially buying a media brand. They were essentially buying a media brand, the same way that HubSpot bought The Hustle, Morning Brew got acquired by Business Insider. Like, media brands are valuable. And a lot of times companies that are good at SaaS or something else aren't necessarily good at building an audience. And they know how valuable it is. So by buying the site, the business itself is like a rounding error. I mean, their ARR is now 300 million. I don't know what it was back then, but it's like absurd numbers. So my ARR was not going to make any dent. So they didn't want it for that. Product wise, it was a bunch of courses that I made. Yes, those are valuable. They were able to put those on their free academy and drive traffic to that and be like, oh, now we have these really good courses, and like level up that feature for lead gen. But they really got traffic. Like my site was getting as much traffic as they were, like 600,000 visitors a month. And they were this publicly traded company with like 50 people on the marketing department, in the blog, like not just the marketing, and like hundreds in the marketing department. So they were like, we could compete or we could just buy it. So and the email list too. I had an email list of like 170,000. So they were able to buy all these basically assets and then just have them in one day. So it wasn't that. Usually with a business, you're more into like, what's the team? Do you have any IP? What's the product? Like, what's your process? Like, they weren't really interested in that. They just wanted to get these assets in house, and then they could monetize them and turn it into more ARR.
Yeah, basically took $5 million off their marketing budget and said, "Is this worth $5 million in marketing? Hell yes."
Yeah, and then you own it too. If you burn it on pay per click, it's gone, right? They still have it now. So we're talking about it 2 years later. In 10 years, they're still going to have it, and they can, still generate some returns on it.
Totally. It's. I think it sounds like a good buy, but also a good sell. That's the best kind of acquisition, that you got good value and they got really good value too, right?
Yeah, definitely. It felt like a win-win. It still does.
Yeah. Cool. So we know we talked about advice, and you gave us some really good one. Any final notes on this before we move on to a little bit of a twist here in the end?
Yeah, I would say the other thing, even though the not worry, like you said, Theis, it's like easier said than done. I would go back and say, if there always is a chance this guillotine could fall and they could say, we're out. But usually, especially the further you go, the less likely that is to happen. Yeah. With a bigger company, especially, it takes so long for these big companies to like make decisions and get everything aligned. Once it happens, it usually doesn't change course. It's very rare. So it's one of those things that, yes, should you maybe like have a couple brain cells dedicated to it? Sure. But every day that goes by, it's less likely to fall through.
Yeah. They commit more and more, put more and more chips on the table, and that's real for them, for sure.
Yeah, and you're going to understand from their perspective, if you're selling as a small business, it's you, maybe a business partner that's involved in the process. Everyone else is probably shut out. For them, they have lawyers and strategic people. They put in probably $1 million just making the deal happen for all the hours put in. The last thing they want to do is back out unless they have a really good reason.
Yeah, perfect. Very good. Thank you, Brian. This was a great conversation. I think a lot of founders can learn from this. Before we let you go, we're going to put one question out there to the both of you. And I have to answer this question every week because I'm always passionate about something. But what are you obsessed by right now? And Theis, do you want to start that one?
One thing that I really spent some time on and just being very fascinated by goes back a long time, but something I continue to find super fascinating, which is communities. Heini, you and I, obviously we built a business around that, so it's kind of close to my heart. But I just find it so fascinating how much value communities still bring in, and I kind of see it. I see it in two very different things that I spent some time on in the past couple of weeks. So one is like AI, super fascinated by AI, and I think there's just a massively interesting conversation around like open source of AI, which is all about a community bringing value. And I think that part, like, I'm really fascinated by that, reading a lot about it. And I really hope that it pans out that way, that you get a super strong open source AI, just like you saw that the backbone of the internet ended up being completely powered by open source. I really hope that the developer community around AI continues to be strong and can continue to build value. And I just think it's super fascinating that you can actually do that you can have this amazing thing being built without these very strong kind of financial incentives on that. So I continue to find the communities super, super interesting and fascinating.
Very cool. Very cool. What do you say, Brian?
I'm going to go with bio tracking. I've been tracking a bunch of stuff. I have the Oura Ring. I got a continuous glucose monitor. I'm going to get an 8 sleep. I never tracked anything. And then I got an Oura Ring and I was suddenly obsessed with the numbers and things I never even knew about. Like I knew HRV, heart rate variability as like a concept, but I never measured it. And then, as entrepreneurs, when you get a number that you can like optimize for, you're going to go crazy over it. So that's basically what happened to me. And once I got the continuous glucose monitor, that was also like, wow, what these foods increase your glucose and all these things you can correlate with it. And then correlate that with the Oura Ring numbers, with your sleep scores and your HRV and all that stuff. So for me, like, I just want more sensors tracking stuff, basically.
Do you have like a screen that says like Brian's body on the wall, or what's up, or what's happening?
I mean, it's just, I wish you could have something that like linked them together. That would be maybe a great business idea, is like you could take your 8 Sleep, your Oura Ring, your CGM, your Whoop strap, and anything else that you have attached to your body tracking stuff in one app, and look at it and try to find relationships, because they're really siloed for privacy reasons. Yeah. And they don't have that like ChatGPT like feature where even in an Oura Ring, which is pretty good UI, you can't see like when was my highest HRV day, or when was my lowest HRV month. But yeah, the number one thing, honestly, like if you're not that interested in, but only mildly, drinking kills your sleep. That's the number one takeaway. It has a surprising effect on sleep, even a little bit. I thought maybe if you're trashed, but even a drink or two makes a massive difference in how well you sleep. So that's been my number one takeaway to start with. Like, whoa, within a week, I was like, damn, this is crazy. And then of course you learn more as you go. And
then obviously sleeping is so bloody important. So if it messes with that, that's a problem, right? Yeah. Cool. I'm going to give you, yeah, very fascinating. I'm going to give you a little bit of a boring answer this time, but I am actually, we've been working on this podcast for a long time, and I'm a little obsessed now I'm going to take a break in July and then figure out how we can come back in August in a more sort of specific way. And I'm just thinking and working a lot on how the heck do I figure that out, because numbers are good. I want them to be better. I always want numbers to be better, but yeah, that's what I'm a little bit obsessed by right now. Fantastic, guys. Thank you very much for coming on, Theis and Brian. It's been a true pleasure.
Thanks for having me.
Thanks, and good to meet you, Brian.
Yeah, likewise.
We've come to the end. Please make sure you follow and subscribe wherever you listen to podcasts, and please leave a review and rating. It really helps. For all of you on YouTube, please make sure you check out Raw Startup, where you find a lot of videos about building a startup. This has been Founders Weekly. Now stop listening and go build something.